Well, thank you, William, for setting the stage, and thank you, everyone, for that very warm hospitality. As many of you all know that I'm from Singapore, so whenever I'm here, I will try the KL food. I must say KL food is always better than Singapore. Better, right? It's not just because I'm here, and it gets better, right, when you get the bill. You compare the price difference. Usually it's better. Same way, if you go to Singapore, you can have a meal which is equal, but when you see the meal don't go so well. That's same with investing, The price is what you're going to pay for it. You want to find value. Same with investing. So when the year started, I met with my professor. He's an expert in the US economy. And I asked him, why is the US economy so strong, so resilient in 2023? It had the whole banking crisis in March, but that didn't bring the economy down. How come it's so resilient? So he gave me one word, one answer. He said, Taylor economics. So for those who studied economics in school, which I did, I thought it was Taylor rule, which is actually a right interest rate setting, such that you'll bring the activity slower, bring inflation down. So I was explaining Taylor rule to him. So my professor said, no, I'm not talking about Taylor rule. I'm talking about Taylor Swift. Oh. So how Taylor Swift works, or Taylor economics work, is that whenever she has a concert in town, wherever she is, it will bring people into the town, it will bring spending, restaurants, hotels, all these will do very well. And the first 8 months of 2023, Taylor Swift was actually in US, and that's why the US economy boomed. So I thought, wow, that's a pretty interesting idea. Then I asked him again, I said, okay, so 2023, Taylor Swift was there, all sorted. How about 2024? What's going to happen to the US economy? There's no more, Taylor Swift is not going to be there, He said, don't worry about the US. There's always the US elections. That's going to create entertainment, and that's going to create some activity. But of course, today, what I want to talk about is China, what I want to talk about is Asia. And clearly, I think the economic gravity is and has been shifting towards Asia. Like it or not, in the next 5-10 years, that would continue to be extremely strong. Almost 40% of world growth will come from Asia. And even China is slowing, make no mistake, China is still a very large economy, number 2 in the world, and even it's growing at about 4.9%, 5%. That contribution still matters a lot. It's going to drive 20% of global growth. It's still a big player. But my message today is that there are other players rising up. It may not be as big as China now, but in terms of that growth rate, in terms of the change, the impact, it cannot be ignored. The likes of ASEAN, for example, the likes of India, it's going to be extremely important in the years ahead. And I think investors cannot just think about Asia exposure in China alone. While that might be the assumption over the last 4 decades, China might just be that growth story for Asia over the last 3 or 4 decades. But if you think about the next 10 years, in the next 10 years, you just can't think about China alone. You have to think about AI, not artificial intelligence, which is important this year and next year, but ASEAN and India, which is going to be crucial in the years ahead. So AI is going to be something, and if this term becomes viral, ASEAN, India, AI, you heard it here from HSBC. So this term might be, unlike our competitors, they came out, 10 years ago, what term? Fragile 5. They put Indonesia, India in it. So now they must be thinking, these 2 economies are now bright spots, So whenever you give name, make sure you give a good name. Don't give a bad name. It might come back to haunt you. So importantly, China, what's happening? I think the whole negative news, everything is well known. You have a debt issue, the property market is weak, demographics is shrinking, policy uncertainty. But if you put all this together, a lot of it is already priced in, I would say. And I think what investors fail to see, to me, the message really is, don't write off China. We are neutral on China, but don't write off. You don't need to be so pessimistic, because there are green shoots. There are glimmers or areas of growth, pockets of opportunity. Take consumption, for example. Service consumption is growing quite strongly in China. So people are still spending, but they're not spending as much. But there are opportunities. In terms of exports, China is growing extremely strong in the electric vehicle complex. They are now exporting more EVs than Germany. That's a big deal. Why is it so? It's almost like beating Germany to their game, of car making. It's like the Chinese football team beating German football team. Very hard to happen. Although nowadays, German football team lose quite often. I don't know for what reason. but I think there are areas where China is actually doing quite well. And also, I think in terms of even the flows-wise, foreign investors are selling out China, but companies themselves, the management, the shareholders within China, they are buying their own shares. So it shows that the management knows something that the foreign investors don't know. So my message is, don't write off China. I don't think you're going to get a V shape, but clearly there are some green shoots. So importantly, also in 2024, is not just about China itself. The real driver for markets, to me, is earnings growth. Asia's earnings growth is going to be around 20% this year, extremely solid. If you compare that with US earnings growth is around 12% consensus. 20% is almost double of 12. So you have to find, there are in fact plenty of investment opportunities in Asia. And of course, one of those big drivers of this earnings growth is largely in Korea because of the manufacturing of memory chips. But that's really because of the entire global environment that's starting to pick up in terms of the electronic cycle. During the pandemic, everyone bought the extra laptops, the extra monitor. But since then, people don't buy that. But I think it has been about 4 to 5 years, and people are starting to change their phones, to change their laptops, and that's starting to reinvigorate a new kind of tech sector, tech kind of rebound. It might not be as big as what we saw during the pandemic, but on the margin, improving parts of Asia, including Malaysia, that is very much geared to this electronic cycle. So earnings is very important, 20% in Asia. But at the same time, when you look at valuations, Asian valuations are actually extremely attractive compared to, let's say, the US. Even though earnings is at 20% in Asia, price to earnings for Asian stocks is trading at 12 times. That's almost about 35 times discount compared to the US. So you get strong earnings growth, but yet valuations are extremely attractive. So there are plenty of opportunities in Asia. And within Asia, yes, we like Korea. We are neutral on China. We like India. We're very bullish on Indian equities. And also we are very bullish on Indonesia. The case for India is quite interesting. And I'll talk a bit more about it later. But certain big shifts and trends are happening around the world. Clearly, China's exports to the rest of the world is actually falling. That's happened over the last 2 or 3 years. And that share is actually going to ASEAN and India, that whole AI team that's happening. A lot got to do with supply chain reorientation, supply chain diversification. But to me, the main reason why factories, multinational companies want to shift to ASEAN and India is not so much for this supply chain diversification, but more because of the rise in the middle class, a huge market. Because combined, ASEAN and India has 2.1 billion people. These are consumers, a rising middle class, they want to spend, and they want to be nearer to the end consumer. So that's why this whole supply chain is shifting, and there are a lot of very interesting opportunities alongside it. A lot of these foreign direct investment flows are flowing from China into ASEAN and India, primarily because of the infrastructure that we have, the trade networks that we are linking each other through the regional comprehensive economic partnership. But also a lot has to do with labor cost advantage and also because the population is very much well educated. But ASEAN and India, the story of ASEAN and India has a lot to do with demographics, because demographics drive economics. If you think about it in China's case, China has had that one-child policy, but that one child is no longer a child. That child is probably about 40 years old. So if that child is married, they are likely to have one kid, typically, and they have 2 sets of parents to look after. So if you think about it, in China's case, the population pyramid is inverted. But in ASEAN and in India, the average age, the median age is actually about 10 years younger. late 20s, early 30s, and this person would have probably 3 or 4 siblings. So if you think about it, the population demographic is actually very wide. It's a real demographics. And as a result, the next 10 years in terms of growth, in terms of productivity, would come from India and ASEAN. And one of the reasons why we are bullish on India is because of the transformation that it has gone through. Over the last 10 years, it has built up its foreign reserves to more than 600 billion. So therefore, over the last couple of years, you've seen a certain stability in the Indian rupee. And more importantly, we are bullish on equity market. Indian equity market has actually registered 8 consecutive years of positive returns, almost unheard of. 2022, when everything sold off, including US stocks, US tech stocks, India actually returned a positive return. And back in pandemic 2020, Indian stock market actually rose 15%. So this year, Indian earnings growth is around 18% earnings growth. I don't want to bet against India. I want to be bullish on India. So this is one idea, one area that we think is very interesting, and opportunities would be alongside the major IT companies in India, some of its banks, as well as some of its consumer companies. Because the future of Asia would really be very much consumption-driven. Earnings growth in that respect, particularly in India, even in China and ASEAN, still looks fairly healthy. So within Asia, a focus on consumption, a focus on consumer discretionary companies is going to be quite important for 2023. And alongside what William has said about capturing yields, about locking in the returns from bonds, you don't just want to look at US and global developed market bonds. You also actually want to focus on Asia bonds. And I think that's very important because Asia bonds, one very important feature is that many central banks would likely cut interest rates this year in Asia, maybe faster than the Federal Reserve and maybe by more. So that capital appreciation that you can get from Asian bonds looks quite interesting. And within Asia, in North Asia, some of the Korean, Japanese financials or insurers actually look quite interesting. And within South Asia, we like India local currency bonds, which later my colleague Jessica will share with you more how you could play that team to kind of capture those yields. So I think in summary, there are a few actions you can do. I started out this presentation with Taylor Swift, and one of her most famous songs is Shake It Off. I'm not going to sing it for you, don't worry. But what we can do is that if we can shake off certain habits or bad habits in terms of investing that we have, if you have concentrated positions in cash, that's a bad habit. You could actually shake it off and kind of deploy it into bonds, for example. So this is one action to kind of do. And of course, if you have concentrated positions in, let's say, some concentrated position in the US, you also want to broaden the exposure to other sectors as well, because there could be other sectors, whether it's in the healthcare, industrials, that could actually do well. And if you have concentrated positions in China, you also might want to diversify into AI or ASEAN and India. So I think the ultimate message this year is that 2023 has been a good year, concentrated wins within certain sectors. There will be broadening out, and therefore you need a diversified portfolio to capture the returns. So I think with that, thank you very much.